Earnings season is in full swing with major companies in banking, tech, travel, and more all releasing their quarterly results. We have expert analysis so you can better understand the numbers and what they say about the health of the American economy.
Higher prices did not stop consumers from grabbing their Chipotle burritos last quarter. The food chain beat the street's estimates in the third quarter. Also saw same-store sales growth of 5%. Chipotle CFO John Hartung joins us now alongside Yahoo Finance executive editor Brian Sozzi. Jack, it's great to see you here. So certainly we're seeing some encouragement here in terms of the street's reaction to these results and move to the upside here in shares today. But what struck me in this report is that Chipotle once again remaining strong, remaining resilient in the face of higher prices, in the face of the fact that so many of your competitors are seeing consumers pull back their spending. What do you attribute this strength to?
Yeah, listen, I think a lot of it is that we are priced lower than other competitors. You know, even though we've had to battle inflation like every restaurant company, when you look at the cost of having a meal at Chipotle compared to others in the fast casual, our prices are anywhere from 10% to 25 or 30% lower. So if you're looking for a quality meal with real cooking and customization and convenience that Chipotle offers, you can't get it at a better price than at Chipotle. And we think that in these times where people are under pressure and they're a little bit fatigued from inflation, Chipotle is a great alternative.
Jack, Brian here, always good to see you. You've been at Chipotle for a while. You've seen really everything almost since day one. Social media loves talking about Chipotle, as you know. What do you say to those folks that suggest Chipotle has lost a step, that it's not the same Chipotle as 5 years ago?
Yeah, listen, I guess there's going to be Chipotle haters out there, but we feel like the food is better than it's ever been. We feel like the convenience because of digital, digital 5 years ago was 15, 16% of our business. Now it's almost 40% of our business. We feel like the people in our restaurants are better than they've ever been. Our stability in the restaurants in terms of holding on to our people is the best it's ever been. And then we have better menu innovation. 5 years ago, we didn't really have menu innovation. So now we've got carne asada, which customers are responding in a big way. A couple months ago, we had chicken al pastor, which our customers love. So are we a different Chipotle? We certainly are, but I think we're better.
Jack, okay, so I am a fan of Chipotle. I like your burrito bowls, your salad bowls. I don't do the burritos currently, just because I'm watching my waistline. But I got to ask you more. I got to dig deeper into the pricing. When you talk about it being, you can't get a better price elsewhere, I do feel like the prices have skyrocketed over the years. What are you watching for in terms of the consumer's elasticity when it comes to your pricing? Where do you say, okay, we can't take it further than this?
Yeah, first of all, the prices that you put up, I think are probably in New York. So that's not what most customers are paying. The average chicken burrito is right around $9 if you go into a restaurant. Now it's more for delivery because we've got to pay for the delivery fee. But go into our restaurant and order in the app and then pick it up. The average Chipotle burrito is right around $9. In fact, more than half of our restaurants, the average Chipotle burrito is under $9. You go anywhere else and get a chicken sandwich or a chicken bowl or a chicken, a salad with chicken, you're going to pay $11, $12, $13. And I'm talking about across the country. So when we compare our prices to others, that's where we're at least 10, if not 20 or 30% below. We also look at either our internal value scores, and then outside of Chipotle, independent studies have done it as well. They ask what is the best value out there, and they will, stack rank us against other companies. We always end up on top. So our customers say it, and when we look at the data, our prices versus others, which you have to do on a market by market basis. You can't compare a New York price to something in the middle of Ohio, but when you compare within market, we're always the better alternative.
Yeah, Jack, when it comes to pricing, I'm curious just to know a little bit more about that strategy because you have been forced to raise prices 4 times in the last 2 years. A lot of that obviously because of inflation, higher input costs that you at Chipotle are facing. How do you see that pricing strategy shaping up going forward?
Yeah, so we just issued or rolled out a 3% price increase because our current food and labor inflation is running about 3 to 4%. Our strategy has always been just to keep up or maybe stay a little bit behind inflation. We don't want to build our business or grow margins based on inflation. We want to grow our business and grow our margins based on transaction growth. And you saw in the quarter, we had strong transaction growth in the quarter. We expect continued strong transaction growth in the fourth quarter. And before this price increase, we didn't raise prices until over a year ago. So we've been over the years, and especially in the last year or so, we're usually slow to raise prices. And you're right, we've had to battle inflation. But if you look at the inflation we've taken on over the last 2 years and the pricing, we've not even fully priced in that inflation.
Jack, and next year, 50% of your restaurants are in California, and they're going to be dealing with higher wages to $20 an hour. How much of a headwind is that for Chipotle? And then, as the CFO, do you pull back on how many stores you are going to open in California over the next few years?
Yeah, first of all, Brian, that is a significant increase. We tend to pay higher wages than others. Our average wage in California is about $17. To get up to 20 as the minimum. Keep in mind, when the average is 17, you've got some below, some above that. To get the minimum to 20, we're going to have to raise wages across the board by somewhere between 17, 18% up to 20%. Significant increase. Our plan is we have no choice. Every restaurant company in California is going to have to do this. We're going to have to raise prices. We've said that. We've not made a decision. We'll wait till we get closer to the April timeframe. But we'll have to raise prices somewhere in that mid to high single digit range. In terms of opening restaurants, we'll still open restaurants. We have more restaurants in California than any other state. We do really, really well in California. And everyone's going to have to raise prices. So I would expect, Brian, when all this is said and done and things settle, that Chipotle will still be 10 to 30% below other competitors in California.
And Jack, really quickly, have you noticed any impact in terms of the weight loss drugs and people cutting down on the size of their order?
No impact at all. And we think we will fare well. We're watching it very closely. At Chipotle, you can get exactly what you want. And so over the years, as people have pursued different diets, you can come in Chipotle. It's like going to a grocery store. You can pick any ingredient and you can custom build your burrito or your bowl to exactly your taste and your diet. And so we think whatever happens with this weight loss drug, I think the customers are going to be able to come to Chipotle and get exactly what they want.
My order's double protein all day, Jack. You know that. You know that.
Love it. I love it. I got to have a meal with you and see that. I got to see it.
Yeah, let's do it. Let's go.
I'm in.
All of us, we're all going to Chipotle in Ohio, where I'm from. All right, our thanks to Chipotle CFO Jack Hartung. Thank you. Alongside Yahoo Finance's executive editor, Brian Sozzi. Thanks to both of you.
Let's take a look at one of the other tickers this morning that we are closely watching, and that's Deckers. Now, the maker of Ugg boots and also Hoka sneakers is trading to the upside. Look at that, gains of nearly 14%. The company moving on its earnings results, sprinting past expectations, revenue spiking 25%. Their DTC, direct-to-consumer sales, jumping almost 29%. Deckers Outdoor also raising its fiscal year sales forecast to about $4 billion, with its CEO saying, quote, the strength of demand for our Hoka and Ugg brands continue to drive exceptional performance during the quarter. And taking a look at some of these sales figures here, Diane, just in terms of where Hoka and where Ugg stands right now, it's huge. Ugg net sales are up 28% on a year-over-year basis, $610.5 million. You have Hoka net sales up 27%. Yeah. We talk a lot about the growth trajectory of these brands, the fact that it seems to remain at least resilient for now. Consumers willing to pay some of these higher prices for these products. Obviously, Deckers in a position to really benefit from that trend.
Indeed. It's so funny. I remember once upon a time where you would occasionally see a pair of Hoka sneakers. Now they're everywhere. They're pretty ubiquitous at the moment. I mean, on my way here from our office, I saw someone, and that's just not uncommon now. And when you think about how Hoka is compared to, say, Nike in terms of running shoes. I know we've talked about this, and even making a bet on the shares of Nike year to date, down 15%. When you look at Deckers year to date, that stock is just surging more than 40%. So if you started out the beginning of this year, making a bet on the company that is behind Hoka, that's behind Ugg, you're winning. If you made that bet on Nike thinking that they were going to continue to run this lane, you bet wrong.
Yeah, and when you take a look at the analyst commentary coming out on this, Piper Sandler saying that the growth at Ugg was the highlight of the quarter. Deckers raising its growth expectations on the brand to mid-single digit from low single digit. Also just viewing that she even believes that this is still conservative when you take into account the factors that are at play, the fact that we do see lower freight costs, favorable product mix at Ugg, and also the higher mix, the DTC sales, setting up the company for success here in this very important holiday quarter.
Exactly.
And then, of course, going ahead to 2024.
That's what I was going to say. It may be on somebody's Christmas wish list. So I think it bodes well for them. Amazon is still staking its claim on AI. While AWS fell slightly short of analysts' net sales expectations, sales were up 12% on the year. For a deeper dive into Amazon's results, we're joined by Arun Sundaram, CFRA analyst. Arun, thanks so much for joining us again today. So let's dive right into Amazon's results. You saw the stock kind of flip-flop in terms of the reaction, and in the pre-market it had been higher. What do you make of its latest quarter?
Yeah, thanks for having me. Yeah, no, I think the story of this quarter is really that Amazon is turning to a highly profitable and free cash flow generating juggernaut. If you look at this quarter, operating profits hit $11.2 billion. That was well above the 7.7 billion estimate, and that's actually a over 300% increase from prior year, and about a 45% increase from Q2. And the best part is that there's still a lot more efficiencies left to be unlocked for Amazon over the next, I would say 3 to 5 years. On the e-commerce side, there's Amazon still finding ways to reduce its cost to serve while also trying to increase delivery speeds. So really a win-win there. We'll likely see more robotics, automation in its fulfillment centers. We have its electric vehicle fleet coming in over the next decade. In Prime Video, I think there's a lot of enhancements left to be made there to improve the profitability in Prime Video. In the international business, it's starting to break even now. So I think going into 2024, we can finally see positive operating income in the international side, which would be a huge positive. And then lastly, with AWS, this quarter, we actually saw a 600 basis point margin improvement from Q2 to Q3 in AWS. And I think that's going to continue growing as well. So really the story right now is on profits and free cash flow. And I think that's what's driving Amazon stock higher.
Arun, how quickly you just mentioned AWS there, the growth that we're starting to see. How quickly do you see that growth then accelerating when we look ahead to 2024?
So yeah, I think the slight disappointment this quarter was that with the fact that AWS growth was it was 12%. So it was also 12% in Q2. So we saw pretty much flat growth Q2 to Q3. Investors really wanted to see that business reaccelerate like Microsoft did. Microsoft saw a 1-point acceleration from Q2 to Q3. I think if AWS saw 13% growth this quarter, the stock would probably be up much higher. But during the earnings call, it was pretty upbeat. Andy Jassy did say that AWS that they signed several new deals in September with an October effective date. So it seems like in Q4, so this upcoming quarter, we'll potentially see AWS growth accelerate from that 12% growth rate in Q3. So we could potentially see 13, 14% AWS growth in Q4.
I mean, there is some concern when you point to the growth that we're seeing or the growth that we have seen from AWS and comparing that to the numbers that we got out from Google earlier this week. Also, what we saw in Microsoft with its Azure business, whether or not we should be a little bit worried just about the risk there that the company is starting to lose more market share. What's your assessment of that risk?
Yeah, I know there's a lot of chatter about whether Microsoft is gaining more market share in the expense of Amazon. I think our conclusion is that it's way too early to tell. And it's really hard to tell because right now AWS is a much larger business than any other cloud provider. AWS is running at a $90 billion plus run rate right now, and it's growing 12%. So that's a massive business. Microsoft also has a big business, but not as big as AWS. And then if you go down the cloud providers, Google's cloud is much much smaller. So you can't just look at just the year-over-year growth rates and determine whether one is gaining market share at the expense of others. All these new opportunities in generative AI and machine learning, we're still in the very early stages of that. So that's why, and right now it looks like all the deals that these companies are getting in generative AI, the deal volume is really lumpy quarter over quarter. So I don't think you can look at just one quarter and determine whether one company is gaining market share at the expense of others. This is going to be an opportunity over the next decade.
And Arun, let's hone back in on Amazon. You talked about efficiencies to be unlocked. What segments are you referring to when you say that?
Well, really, it's in the e-commerce side. The e-commerce business, wasn't profitable last year. Really hasn't been profitable for the past few years. And we're just starting to see that business become profitable. So it's been a few quarters now of positive operating income in that North America segment, which includes e-commerce, advertising, everything except AWS. And then one of the biggest reasons why we're seeing profit improvement there is that Amazon actually moved from a national fulfillment network to a regional fulfillment network. And by doing so, it's actually lowered its cost to serve because now you're shipping goods closer to the consumer, and it's also increasing its delivery speeds. So that's been a win-win there. And like I said before, I think Amazon's still very much in the early innings of improving efficiencies in its e-commerce business. I think over the next 3 to 5 years, we can see those e-commerce margins improve even more, especially as it rolls out more robotics and automation in its distribution and fulfillment centers, as it rolls out more electric vehicles in its fleet, as it finds ways to continue lowering its cost to serve. So I think there's still a lot of efficiencies left to be unlocked there. And then on the international side, like I said before, that business hasn't been profitable. And this quarter, operating profits in the international business was negative $95 million, which is a significant improvement from prior quarters, but it's still negative. And so the expectation is, as we go into 2024, that international business can start becoming profitable, especially as Amazon scales its presence in some of these emerging markets, which is still very much early in the whole e-commerce side. So we're positive on the whole operating profit, free cash flow story of Amazon. And I think that's what will drive Amazon's stock over the next year.
All right, Arun, always great to get your perspective, CFRA analyst. Again, Amazon shares moving to the upside here in the pre-market, up just about 6%.
Another company we're watching, Ford. It released its third quarter results on Thursday after the bell, missing expectations. Now, this comes just after the UAW and the automaker reached a tentative agreement that will be voted on by union members this coming Sunday. We want to bring in Yahoo Finance's Pras Subramanian, who has been following all of this closely. Pras, take us through the latest.
Hey, Diane. Yeah, so a highly anticipated report last night following the big news of that UAW tentative deal. And then they reported mixed results shortly after that. But a few things stood out to me with the report and also the ensuing conference call. So the first thing was Ford said that it was on pace to hit its improved outlook before the strike. But as you know, it pulled guidance last night, similar to GM, due to uncertainty here. Ford said it lost $100 million in Q3 and $1.2 billion in Q4 due to the strike. But it said that its costs are still unknown as it restarts production. So I was a little surprised to hear we didn't get an updated figure yet. Well, they said they will issue one shortly. Number two, Ford is pushing back its EV investments, saying last night it's going to push out around $12 billion in those EV investments until capacity is needed. It means they're going to pause some plants that were scheduled to be built in the next couple of years. Ford said in a statement that many North American customers interested in buying EVs are unwilling to pay premiums for them over gas or hybrid cars, thus sort of compressing profitability and prices. So it's a challenging environment over price with EVs. And now they're saying that they still want to keep investing in EVs, but they want to sort of focus on their next gen cars because their current cars aren't necessarily competitive on cost and features, basically saying that Ford is not competitive right now compared to Tesla. And finally, it's unclear in what they said with the tentative deal that if battery plants are part of the UAW agreement. Ford CFO John Lawler on a media call declined to say if unionization at battery plants was part of the deal. Now, Ford, of course, isn't at liberty to talk about these things because of the fact that they still need to be discussed. The UAW is still discussing these things with their membership before they can vote on it, like you mentioned. But this is a big reason why the UAW didn't strike additional GM plants a few weeks ago, because it said that GM agreed to include battery plants as part of the master agreement, as they call it. So it's unclear if Ford has this sort of provision in the UAW contract that it agreed to, but I can't imagine it doesn't after the UAW made such a big deal about those battery plants included into the master agreement.
Pras, I'm curious we've gotten a slew of news within your sector this week when it comes to UAW strike, what we heard earlier this week from GM, even yesterday with Mercedes-Benz, obviously talking a lot about the EV pressure there, and then also what we heard last night from Ford. I guess, how does that then change the landscape when we talk about whether or not some of these more traditional automakers are able to compete with Tesla at this point, given the fact, and really on the heels of the comments from Jim Farley last night, talking about the fact that cost is obviously the most important thing right now, and they don't have, I guess, the competitive advantage that Tesla does at this point?
I think what's happening here is these traditional legacy automakers, as we call them, assumed that EV demand would be pretty strong even at this point of the cycle of where we are economically, and that they could charge higher prices to sort of defray some of those investments that they need to make now as they try to catch up to Tesla. And what they're discovering is that the demand is just not there because the price is so high. I think, taking a step back, we are seeing that EV sales in this country are past an inflection point. They have been rising quarter after quarter after quarter. They're just not supercharged just quite yet. And I think a big problem of that is, of course, pricing, but also we mentioned the charging infrastructure, the lack of that, those chargers in the country is a problem for people. So they're kind of concerned about, well, I should invest in an EV when I don't know if I can charge on the road. So I think it's like a dual sort of problem that the legacy OEMs are facing, whereas Tesla, of course, they're right now enjoying those benefits of scale. They can make cars cheaply, EVs cheaply, they can sell them. The question now is how willing are they going to go to sort of cutting prices to give the consumer what they want? We know that people are paying a sort of higher price for Tesla shares because they think that the margins will remain high. That remains to be seen. But I think there's definitely an inflection point here. We're not changing our course in terms of where the country's going from an EV point of view. The question is, how long is it going to take to get there? And now it seems that it's going to take a much longer sort of time frame before the country is majority EV.
And Jim Farley saying great product is not enough in the EV business anymore. We have to be totally competitive on cost. So it really sums up just where the auto industry is in this transition. Subramanian, great stuff. Thanks.
Intel shares are jumping this morning after the company pledged that despite seeing its 7th consecutive quarter of sales declines, its cost-cutting efforts will result in growth to come for the current quarter.
Remain on track to reducing costs by $3 billion in 2023, and we continue to see significant incremental opportunities for operational improvement as we execute on our internal foundry model.
And the chipmaker also gave a better than expected sales forecast as it battles with waning PC demand. Yahoo Finance's Dan Howley is here with more. Dan?
Right, Diane. The big news here for Intel obviously is a beat on the top and bottom line, but there's a little more to dig into. So let's just go over the base numbers. Revenue for the quarter came in at $14.2 billion versus expectations of $13.5 billion. EPS came in at 41 cents, adjusted EPS, versus expectations of 31 cents. Part of that has to do with the client computing group. That's basically the PC chips that they sell to other vendors. That came out at 7.9 billion versus expectations 7.4 billion. So seeing a uptick there, continued uptick as far as overall revenue goes for that group, and that leads into the recovery for PCs that we're beginning to see. PC sales should start to really pick up now after really difficult comps from last year. And if you listen to Gartner, for instance, they'll tell you that they're seeing improvement as far as overall PC sales go into 2024. One of the things that's worth pointing out, though, is while they did beat on the client computing side, the AI data center side missed. That revenue came at 3.8 billion versus expectations of 3.9 billion. And you would expect that, with the AI hype and craze going on, that would really have caused the stock to get hammered, but not so. Intel basically continuing to turn itself around and returning to profitability after a big miss a few quarters back. I think seeing the results that came in, investors were more than happy to get that. And one other thing I want to point out is during the call, Pat Gelsinger basically, obviously went over the entire roadmap that they can for now as far as what they're doing with Foundry, with chips. But he also was asked about potential competition from NVIDIA and Qualcomm building their own CPUs. Now, NVIDIA does make CPUs. Obviously, they're known for GPUs, graphical processing units, but they also are making their own CPUs in servers. Those are only for servers right now. CPU is basically, if you don't know, the brain of any computer. And you need them to work alongside GPUs to have anything really work well for you if you're doing AI. On the PC side of things, though, Intel is reportedly working on its own CPU based on ARM technology. Qualcomm just unveiled its own CPU. And so Gelsinger was asked about the potential competition, and he basically poo-pooed that, kind of cast it aside. He said, in the past, ARM and Windows alternatives have been relegated to pretty insignificant roles in the PC business. He said that while they take all competition seriously, they're going to let history be their guide here, and they don't see these potentially being all that significant overall. So kind of just, slam dunking on the upstarts, even though those same upstarts are dominant in their own respective fields, Qualcomm in mobile and NVIDIA in GPUs.
Shares of Royal Caribbean ended the day higher after the cruise line reported better than expected third quarter earnings and raised its full year guidance. I spoke with Royal Caribbean Cruises CEO Jason Liberty on where the optimism about demand is coming from.
First, it's really great to be here, and I am actually on a ship. It's not just behind me. So I would say the optimism comes from a lot of different things. I think first and foremost, we have about 130,000 guests sailing with us today. And we have that each and every day, and we have we have millions of interactions with our guests each and every day, whether it's via web, whether it's them booking directly with us, whether it's coming through our wonderful travel agency community. So we're seeing a very healthy consumer, especially our consumer, where the average income is at least average household income is at least $125,000. We're seeing that consumer not only make very strong bookings today, but they're booking 6, 12, 18, 24 months out. So we have that visibility on how they're trading each day, and they're not only are the volumes above what we have expected and what we have been seeing, but they're at better pricing. So you combine that with the incredible onboard spending behavior that we're seeing, that's what kind of fuels that optimism. But it all feeds into our general formula. Moderate yield growth, moderate capacity growth, good cost control leads to margin expansion, high returns, and step changes in our earnings.
And you mentioned pricing as well, and you also mentioned the amount that people are spending on the ships, which you mentioned has been really increasing and has been a pleasant surprise for you guys. What do you see in terms of pricing trends, not just on board, but for the trips themselves going into the next year?
Yeah, so we continue to see elevated pricing, or pricing continuing to increase as we go into next year. And of course, we're also seeing increases in onboard spend. One of the things that we've gotten a lot better at is being able to get our guests to plan their activities and book their activities well in advance of them getting on the ship. We kind of give them a day back of their vacation, and they have a very good understanding of what the broader offering is. And that's one of the things that's also boosting our onboard spend. And they're able to kind of consider that in the total package. And when they compare that total package between ticket and onboard to what they would be paying on land-based, it's still at a pretty significant discount to what they would pay if they were on a land-based vacation.
One of the other interesting things you talked about on the call is, of course, you, like all corporate leaders right now, are seeing some economic headwinds, or at least conflicting signals when it comes to the economy. But you said you see yourself, if I'm reading your comments correctly, as sort of resistant to some of those headwinds. Explain that to me a little bit more. I mean, do you see people, for example, cancel trips when the economy starts to contract a little bit, or do people stick with it and they just, because they booked it already, they just go on the cruise?
Well, I think it's a couple of things. So one of which is, I think there's a lot of macro trends that relate to the entire population or a different set of different markets. Now, we source our guests from all over the world, and so a lot of those macro trends could be relevant, but when we get into those trends that relate to our customers with their saving rates, their current wealth levels, when we look at their saving rates, et cetera, and most of all, their propensity to cruise, which is reaching all-time highs, and you combine that with a value gap to land-based vacation, even if that consumer is a little bit weathered, when they're still going to take a vacation. And of course, we're trying to close that value gap. But with that value gap out there, we think those are additional tailwinds to why we're seeing a continued uplift in demand on both volume and pricing.
And finally, Jason, I did want to ask you about Israel and the effect of the conflict there, which you talked about, of course, in the release and on the call, that it's taking out about 1.5% of the capacity, relatively small effect. You also helped evacuate some of the folks there. So what is the current situation? Are you still helping with some evacuations? And, how do you model out something like this, which is so difficult to predict?
Yeah. Well, I think first, we're pretty kind of late in that European season, so we have very few sailings that were really even left to go into that part of the world. obviously, we reacted when these kind of horrific acts and situations occurred in Israel, and this conflict kind of continues on. It is only about 1.5% of our business, and I think it's important, a few things. One, we have a very kind of balanced portfolio of markets and destinations, and there's always, within this large kind of geopolitical world, there's always going to be some things that do a lot better and some things that do maybe a little bit worse, or some things that we have to turn off. In this case, currently, like the trips out of Haifa, and we build a model to be able to play when it rains, and I think that's really important. For us, when the U.S. called on us, and it was a very easy yes for us to help out, and of course, most importantly, for us to do this pro bono. We felt that was very important. And of course, we're still engaged with the State Department, and we take direction directly from them on when and how we can help get more Americans out of Israel.
And finally, one more quick question as we're talking about international markets here, and that has to do with China, where you guys are ramping up. What do you expect that cadence to look like, considering that it's really been quite a lumpy recovery there?
Yeah, well, we're stepping in with kind of our first toe here, so we'll start operating there in the spring of next year. The Royal Caribbean brand, by far has the strongest awareness and appreciation there in China, and they look for a kind of international experience that's delivered with the China element, and we are masterful at that, as all those guests are really from the China market. So we're stepping into that. Demand looks exceptionally strong, so we're very happy with that. And then as we go through the season, we'll evaluate what our growth expectations will be for 2025 and beyond.
And that was my conversation with Royal Caribbean CEO Jason Liberty. Well, Overstock reporting mixed third quarter results today following the purchase of parts of Bed Bath & Beyond earlier in the year. The company, by the way, announcing this week it will rebrand. It will become Beyond Inc. Revenue, by the way, did not meet the street's predictions, but the losses did come in smaller than expected. Joining us now, Overstock CEO Jonathon Johnson. Great to see you, Jonathon. As always, talk about the quarter and the integration here. I want to start with kind of, if you could, a bit of an explainer, because you all reported that revenue fell 19% year over year. The acquisition of the Bed Bath & Beyond assets, and more importantly, the rollout of the brand in the U.S. as part of Overstock, happened later in the quarter. So talk to us about the cadence then and how that decline kind of factored in as the quarter went on.
Well, we did miss the top line, but there were a lot of things that we really liked about the launch. One, it happened quickly within 33 days after the acquisition. And two, that we saw an increase in active customers of nearly 300,000. These are people that hadn't shopped with us in over 12 months or had never shopped with us that came to shop. August was great. The launch was really strong, followed by September's Labor Day, which was strong. Historically, the end of September is usually a little slower, and we saw that too. We do think we're in a good position to capitalize on the upcoming holidays. We have an exciting new national branding campaign that we'll be launching next week. So we're very confident that with this rebrand, the holidays will be better to us than they've been in the past.
Yeah, I'm interested, Jonathon, just to dig into more of your outlook for the holidays that you mentioned there, because as we all know, consumers are facing some challenges here. Rising energy prices, higher borrowing costs. What do you see coming up here in the holiday season?
Well, I think the holidays are going to be highly promotional. I think they'll be challenging. As we've added over 2 million product SKUs to the site since the announcement of this deal. Those are really across good, better, and best product categories. We do see people trading down some, and we have the product to give them. We're going to be bringing back the 20% off coupon, and as part of our national branding campaign. We know that as people spend at the holidays, they'll be trying to stretch their dollar this year a little bit more than they have in the past. And we think we're good at that. And we think Bed Bath & Beyond is a brand that they're used to coming and purchasing gifts, and they're used to coming to purchase tabletop and other decor that they use when they host for the holidays.
So, Jonathan, we've talked about this a little bit in the past, what buying these assets have done for you guys. Does it also diversify you away from being overly reliant on home, right? If you're going to lean into the gift-giving aspect for the holidays, we've been talking almost on a daily basis about the sort of freeze in the housing market. How are you viewing that market right now?
Yeah, I think for the fourth quarter, we'll be better than we have in the past because of the gift giving. Home is not particularly a strong fourth quarter category historically, but with more giftables, we think it will be stronger for us. Another thing we talked about on our earnings call today, and it's part of our renaming the corporation Beyond, is that we can go beyond being just a single site retailer. We plan to, in the next 12 to 15 months, reimagine the Overstock site, stand it up not as a competitor to Bed Bath & Beyond, but as a cross-category Overstock branded clearance and liquidation site, going back to our roots of almost 25 years ago. So we are looking at ways to become less affected by swings in portions of the economy. And, high interest rates, low housing sales, they certainly have made it tougher from a macro perspective for our industry.
And does sort of that return to your roots, if you will, with a reimagined Overstock.com, does that also lean into maybe some anticipated economic weakness as well and people looking for bargains more than ever?
If we go back to how we began, periods of high beta were good for the clearance and liquidation business that we started 25 years ago. I foresee that continuing. Good times, bad times, they're always, when times of high beta is when manufacturers and retailers have inventory adjustments they need to make. That's what liquidation's all about. That's in our future, but we're most excited about what's in our immediate future with the holiday season. We're starting a new brand campaign. I think it's going to be an exciting time for us.
And Jonathon, from my understanding, you're also looking for a chief marketing officer. I'm just curious how that search is going and when you all think you'll be able to fill that role.
Search is going well. There are a lot of very qualified candidates who are interested in being part of the iconic brand that Bed Bath & Beyond is. We know that there are a lot of great candidates who right now are interested in us, but are focused on delivering for their current employer in Q4. We're heads down, delivering Q4 too. I suspect it will be kind of after the shipping cutoff that we'll start bringing some of these qualified candidates in for more panel interviews. I suspect it'll be mid Q1 where we'll have a really qualified chief marketing officer in seat.
Jonathon Johnson, thank you so much, sir, for joining us today.
Thank you, Josh, Julie.
Southwest shares are on the move after the company said moderating demand and a shift towards pre-pandemic trends weighing just a bit on the business. You're still looking at gains of just about 1%. CEO Bob Jordan telling investors, quote, as we move into 2024, we are slowing our available seat mile growth rate to absorb current capacity, mature development markets, and optimize schedules to current travel patterns. Taking a look at some of the additional results here within what we're getting from Southwest. They see capacity increasing 10 to 12%. That was down from the prior plans of increasing that as much as 16% through the Q1 of 2024. We talk about sticky inflation. We talk about higher labor costs continuing to weigh on Southwest business. We've seen particular pressure on a number of these discount lines. They're being forced to offer even better sales, trying to boost some of that demand here going forward. And we take a look at the stock performance over the last several months and really since the start of the year. Yes, we're looking at gains today, but shares are still off just about 30% year to date. Over the last 3 months, you're looking at losses of about 34%. It's the worst performer among the 5 largest U.S. airlines. We know they started the year on a rough note when we talk about the outage there, all the canceled flights, the backlash that we then saw from customers, and now they're dealing with the fact that they could have a demand problem.
Yeah, for customers that are concerned, or at least thinking about how Southwest has moved past that, or if they've been able to fully rectify what took place here, just do a hot search for capacity and see what they're talking about on that. And you brought up some of these points that they mentioned within this release, and notably coming directly from the leadership at the company saying that they are flying the full fleet right now. They're completing the restoration of their network, moving into next year as well, slowing that ASM growth rate. You mentioned that, absorbing current capacity, mature developing markets, and then optimize schedules for current travel patterns. Now, those travel patterns, that's what's going to be even more in focus, especially in the fair pricing mechanisms that airlines are going to continue to put forward. So even beyond the holiday season, when you look at the normalization of those travel patterns, that's where, for Southwest Airlines, for United Airlines, American Airlines, Delta Airlines, that's where it's going to perhaps be a leaning back into, okay, the stickiness of the ecosystem that they've created, whether that is some type of rewards and relationship that they have on some of their most frequent flyers. And those programs, typically, when there is a pullback in demand, you see a leaning into, okay, here are the other incentives that we can add on to make sure that if you do fly, then you're still flying with us. And that's typically where you see kind of that cycle tend to navigate. But it still comes down to capacity and how all of these major U.S. airlines are trying to get back to pre-pandemic capacity in a year where the TSA travel throughput is finally looking like it's going to eclipse on a full year scale the pre-pandemic marker of 2019.
It does, but I do think that a lot of these cheaper discount airlines obviously are really suffering from the fact that a lot of people who are still traveling, they're favoring to go overseas. We certainly have seen the international component from United, from Delta, from American really helping their results. When you take a look at a company like Southwest, the exposure, obviously, how much they rely on the domestic travel, the fact that people aren't traveling as much domestically could continue to weigh on their business, especially during this current quarter, very important holiday quarter here for the sector.
Shares of Mattel are trading lower by 6.6%. That's despite the company reporting better than expected third quarter results. The company did come out with an outlook that disappointed some investors. Joining us now for some perspective, Citi Leisure and Travel analyst James Hardiman. He also happened to initiate coverage on Mattel last week with a buy rating. James, it's good to see you. It's always good to see you. There were a lot of high hopes for Barbie here, right? Not just for last quarter, but more going forward into the holiday season. What do you think is going on here at Mattel? What's your first blush reaction?
Yeah, I mean, the first blush reaction is that this is not a Barbie issue at all. What's become clear is that I think a lot of investors are trying to look at their business sort of ex-Barbie, I should say, so that we can try to figure out what earnings power looks like for 2024. And so it was a really good third quarter. They beat by about 33 cents, but they only raised by a nickel. And so I think the interpretation here is that the fourth quarter is guided down, call it 27 cents. I think the implied guidance for the fourth quarter is 26 cents. The street was at 48. And so the interpretation here is that they're guiding down the rest of their business effectively for the fourth quarter. I guess the other way to look at it is they had sized the Barbie effect about a month and a half ago to be about $125 million. That's about a 20-cent benefit. And again, they're only raising 5 cents here. And so I think a lot of people are just thinking about how difficult it's going to be to hit the 2024 number, given that the 23 numbers are barely going up, despite what was a really impressive contribution from Barbie.
And James, on the top line in your note, you point out the missing narrative ingredient here is the reignition of the top line. So do you see reignition happening here, James, on the top line, and what would drive that?
Yeah, I mean, certainly they grew the top line nicely in the third quarter. The implied revenue growth for the fourth quarter is about 15%. So we are beginning to see that pick up. The challenge is the street was at about 25% growth for the fourth quarter. So, we're seeing the reaction in the stock, which is, effectively that growth that they're guiding to implicit in the fourth quarter number is not quite what the street is looking for. And maybe more concerning that it's going to be a challenge once we get to the third quarter of next year and the fourth quarter of next year, for that matter, to lap this pretty meaningful Barbie benefit.
So I'm looking at gross billings in North America in particular, which were up 10% overall. Strength in dolls, including Barbie, not surprising. Strength in Hot Wheels, and weakness in pretty much everything else, from action figures to building sets, infant, toddler, and preschool. That's Thomas and Friends, the well-known brand there. What's going to reignite this stuff? Is it going to be some of the property, some of the other media properties that they're talking about linked to some of these brands? Is it going to be the macro environment? What do you think?
Yeah, I think it's all of the above. I think you nailed it. Dolls are doing really well. Vehicles are doing well. Preschool is down a little. Action figures are down a lot. Now, the latter, I think, is a function of some difficult entertainment comparisons. And so in any given quarter, any given year, you've got a portfolio, and some of your brands, some of the categories are going to be up and some of them are going to be down. I think as you fast forward to next year, interestingly enough, I think preschool and action figures should at least flatten out. The challenge is, what's going to happen in the dolls category. Interestingly enough, vehicles have that category has maybe been the most resilient over the last few years. Did well during the pandemic, but even post-pandemic, we've continued to see growth there. So, a lot of it is sort of what's going to offset what. And I think as we sit here today, I think investors are struggling with just how conservative is this guidance, or does it reflect a real slowdown in top line trends ex Barbie? But the other piece that we don't know is, what's the entertainment opportunity for next year? So many of these toys are really driven off of entertainment offerings, that their demand is a reflection of entertainment. And so until we have a better idea of what the entertainment slate looks like for 24, it's a little difficult to tell.
James, I gotta say, you don't necessarily sound like a guy with the buy rating on the stock, right? At least the tone that you're expressing is much more uncertain. Why buy the stock here?
Yeah, I think so much of the hedging, the uncertainty is the same thing that I think investors are faced with here, and that is this is an uncertain holiday season, right? And we felt good to be able to maintain their guidance, hopefully raise, and we saw that. But now we got to button up for a holiday season, which, by all accounts, consumers are pensive. Consumers are conservative. They're being hit with higher interest rates and higher inflation. And so we're going to have to see. I think longer term is really the excitement that we have for Mattel. And I think what a lot of this analysis misses is I do think the success of Barbie is not just a one-hit wonder. I think there's opportunity for sequels. I think there's opportunity for Mattel to really step up their entertainment game in some of these other brands. Is that going to help the comparisons in 2024? Maybe not. But I think if we think from a long-term perspective, once we get past some of this macro malaise, once we get past some of these difficult comparisons, I think there's a lot of value here.
All right, we'll be looking ahead to the Hot Wheels movie and whatever else is coming down the pike. James Hartung, great to catch up with you as always. Appreciate it.
Likewise. Thanks, guys.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.